Hi everyone, I hope you're doing well. So today we have a question and answer video. One of our members have uploaded one video and he has a question. I think that it's one of the valuable questions that we have. Let's go ahead and watch that video and see what he's
Hello,
asking.
brother. So you see,
Just a second.
we had a daily bearish engulfing, inside of which, if we drop time frame, we we see here a base, right? We see a base here, but some momentum, right? So if you use this as our framework, right, we have another engulfing here, right? So we could count inside of this leg here, inside of this drop here, momentum. And we see no kind of special base here. There's nothing. So I guess we would drop again time frame. I mean, in my case, I saw candle liquidity level here. And so you see we have on the 15 minute, maybe we can look on the 30 minute. Anyway, 15 minutes, we had this base, right? Drop, base, drop. So the question is from there, how do we proceed, right? Because it's not Friday, right? I'm just trying to reverse engineer the entry, right, from today, right? So we had a reaction of this base here, but it was a 15-minute base. Let's try to be pragmatic. We're on the H4 of that base here. Do we have any engulfing? No, we don't have any engulfing. I mean, in my case, yeah, I see a supply zone. We have a supply zone. On the H1, we have a bearish engulfing right here, right? It's right here, but we see that in this bearish engulfing got swept, right? And in my case, here I saw what I call an exploration 6, right? The trend starting from this high here, right? As a reaction of from the um, base we saw earlier inside of the 4-hour H4 drop. So how do you link those pieces together? How do you link those pieces together? The price hits our base, right? You could eventually take some short from there, right? Using a confirmation or whatever. But how do you piece this together when price is right here today, right? How did you take, what was the context of your setup today?
Okay, thank you for the question. Let's go ahead and start answering this question. So what he's referring to is on one H time frame, if I can find that part. Yeah, it must be here. So here, just right there, I'm going to put a line over there so that we can see it clearly. Now, his question is that how did you just take these trades? Okay, so in the lower time frame on M1, you can see these are the trades that we have. So the thing is that when you're trading, the first thing that you have to consider that is that what is your playground? Okay, so the scale up and the size of your playground defines many things. So sometimes you're taking trades, let's say here in this leg that we see. Okay, as you see obviously here on 1M, the same. If I draw, for example, I mean this one, this leg. Okay, so you see this one on M1. Okay, this is clearly going up. So if I want to insist and just want to trade and take short trades here, my stop loss would be hit. Why? The reason is that each time frame has its own swings and its rotation point. Okay, so rotation point means that how far one asset is just moving, the range that it has. Okay, it is just bouncing up and down. Okay, each time frame has its own bouncing range, let's say rotation point. So if you want to just take trade on 1M, 1 minute time frame, so you'd better to just go at maximum 1, 2, or let's say 3 time frames about it to just have drop down analysis. So here, for example, if we consider this leg, which is coming down, I have drawn this one before, I have drawn it before I took the trade. Okay. Now, here, I usually, this one is for me M15. Okay. So later, so when I have this M15, okay, now the area that I took the trade is almost here, right? Like this is my first trade, this is my second trade, and this should be my third trade. These I had these two trades here back to back, 2 and 3, and this one was the last one. If I don't know if you can see that, let me change my, okay, I can, yeah, my first trade was here, the second one was here, third one was here, and the higher time frame. So when we're talking about taking trend following setups, okay, you have to consider here, okay, when you're trading, okay, and I just took this trade here, right? Look, and now if you go in this time frame, we have this engulfing that is going down, right? This one, as you see here, okay? So the blue line, let me maximize, okay, this chart, you can see that. Okay, now that I drop the time frame down, so here I have this engulfing zone, right? And also this one, these two, okay? So it says that this is the area of liquidity for us, right? Now, later on, when the price is coming back to this area, okay, as you see here, again, inside this one, okay, inside this one, if I just turn on this, yeah, actually it is turned on, and if I go back so that it can show this part as well. So here, inside this area, we have liquidity zone as well. Look, this one was the highest liquidity zone we had, okay, but it was before. Now, if I want to uh, refine and show what I saw inside this one, okay, so this is our M15 engulfing. It is pushing the price down, okay, because there are a lot of sellers here that they're willing to just drive the market down so that you cannot see okay, what happens inside it. Okay, to see it, you need to just go to the lower time frame. So this is our first drop-based drop. Okay, and inside that one, in this scale, the word scale is important. Okay, you can just consider scale as a time frame. Okay, so inside this M15, M5, okay, we have this engulfing. This is the accumulation of the orders that they drive the market down. Now we have some decision points here to just drive the market down. Price needs to mitigate those areas. Okay, I'm using the terms that is familiar for you. Okay, so that you can understand that. As soon as we have this rejection from this line, I mean here, so we have this sweep. So I took the trade. Okay, I didn't trade it. I just took wanted to issue and let it go. It was set and forget. Later on, the same scenario, the same analysis happened here, and one mistake that I had. So I'm going to explain. So now let's go down again, top-down analysis that we have here. So then I came to M15, sorry, M5, okay, as you see here. Again, I found this area. I think that we have it in, yeah, here. As you see, this is our area. Okay. Now, later, when it is breaking down, we have this one. We need to just find one drop base drop here inside. This is our first drop base drop. Okay. So this drop base drop, when I go inside that, okay, we can see in this drop base drop. So this one is our drop base drop. This was break-even trade. It was almost the winning trade. But here, the trade I took was based on this engulfing and also the lower drop base drop in M5. Okay, here. So the mistake here was that the trend has already change the direction in the leg, okay? But here it was not obvious when it was the live market, okay? So later, after it is done, you can just see it. That's why I try to make this one break even. I usually don't make it break even, okay? But here, because I was thinking that, okay, the direction may change or it's a pullback with a deep retracement to this one, or even this zone, okay? Because we have leftover orders here. So, or some leftover orders here, okay? Price couldn't make here to just get an fill this unfilled orders, okay, consume them. Later, what happened? So after I had this break even, okay, now this momentum, this breakout trade that happened here, okay, I took the trade based on this most recent high low. So I had already made a video about that. I'm going to upload that with explanation and examples. So, and I was sure that here it's going to bounce around, and when it is bouncing around, so it's going to come down, okay? That's why it's called high risk. So that was the reason I took my trade here to make up for this, let's say, loss. And this one is break-even trade, by the way. So one and almost, because it was not full two, it was one and a half. That's why I had something like two-ish or three-ish here. And this one was making up for this loss. And that's all. I hope it helped you. But the point is that you have to consider momentum. Okay. So context around the price. You cannot go up to daily time frame and try to just take trades out of M1. So the relationship between time frames are really important. Sometimes when you have very strong momentum, so it means that there are a lot of imbalances. Okay. So the price wants to just go and fill those leftover orders. When you want to just take trades, like sometimes H4 could match with M1. It depends on how strong the market is. I mean, the price is. Okay, you have to just follow the trend, but you have to adjust your stop loss, and your expectation should be based on that scale that you're taking the trade. Okay, otherwise you would have uh, a stop loss hit, and you would get frustrated. So for the new traders that they want to just have a context around their framework, so I'm not against indicators. I'm not against anything else. Okay, so many people argue that indicators don't work. Uh, but if you know what you're using this indicator for, it is helpful. If it gives you some visual help, why not? But you have to know what exactly you're looking for when you're using indicator. Indicator is just a tool, and the other things that happen is inside your mind as analysis. For example, here, let me go if I have a BBMA. Yes, here, look. Now, if I let me put all BBMA on all the charts, you would get this one as well. So, for example, in Bollinger Band, okay, here we have clear downtrend, okay? So you have to consider that where the price is retesting. Usually in BBMA, they're trying to catch this re-entries or retest of the moving averages, okay? So I'm going to make a video about this one because although it is an indicator system, so because it has a clear rule where to exit, where to enter, this is the thing that really helps you. Many people are just taking guard against indicators without knowing why, okay? Maybe they say that, yeah, Al Brooks, I don't know, if Miante, Michael, they're so successful because they're not using indicator. I would say that it is not about that one. It is about their experience. When they're using price action, they have already used these indicators, okay? And these indicators are there inside in their minds, okay? So for those that they are been using just price action, so are your results better than people that they have been using indicators? Okay, if so, okay, continue doing that. But if not, okay, maybe they're even having something that to help them, okay, but you don't use those things, okay. Anyways, so this momentum, okay, when you have this 50 EMA, okay, and pulling your band, which is a standard one, I think 20, and this one high and low crossovers, the red one and green one here, okay? So when you have the retest of it and you have the clear downtrend, okay? So the odds are on your side. So now that you're using this engulfing system nested inside this indicator so that it shows, yeah, okay, trade is going down. What was my mistake here? Look, now clearly here when the price is going backwards here, okay, and it is retesting this area, I should have looked for confirmation on this time frame, okay, extreme. While I don't, the extreme happens here, okay, extreme based on in BBMA is about to happen here, okay, and later on after price is losing its stream and its strength, okay, here I should have just traded, I mean, sell setups, okay, short setups. So this one is low probability trading area. If you want to just consider trade is coming extension, pullback, extension, deeper trades and pullback. Again, we're expecting extension, okay? So these areas they are pullback areas, okay? They are what? They are low probability trading areas. So you would say that, okay, we have a lot of engulfing when we have this extensions, okay? Which one to consider? The answer for this one is momentum, okay? So if you have a trend, strong trend, okay, price cannot make to come to have the deeper retracement, okay? But if you have a sideways trend, okay, so most of the time ICD stuff are usable in sideway markets. RTM stuffs are usable in sideway markets. Okay, sideway market could be pullback is a sideway market. Yeah, each sideway market in the higher scale is a pullback. Okay, for the higher time frame. Okay, and for the lower time frame, it's a sideway area. Okay, so most of the time, these liquidity hunts and these stuffs happen in the context which is sideway. So they're trying to they have no other way because they need to just hunt the liquidity to make the price go around. Okay, so price is like a ping pong, okay, ball. So it needs some inertia, okay, trigger to just move on. Okay, otherwise they cannot make the price to just go in their desired direction. So I hope that this helped you. And if you have any other question, just feel free to post it in our group. So the next video will be about our most recent high, low, or break even. And later I'll add BBMA for the traders that they need it. Okay, I myself sometimes use it. There is no harm in just using those stuff. And that's all. Okay, I'll just explain the relationship between time frames. You have to know how to break one leg to a trend and try to trade the swings of that. And that's all. Thank you for your time.